Wait, how did crypto get so huge anyway?
Well, it started something like this. In the 1980s, people began imagining a world where money could be entirely digital. Money you could use on the internet without needing physical bills or coins. But there were three main issues that needed to be solved before it could become reality. First of all, double spending. Unlike physical cash, digital money could be copied, allowing the same coin to be used multiple times, which was a problem. The other was central control. If one person or company controlled the system, they could exploit it, which was also an issue. And finally, trust. People needed to believe the system was secure and fair, or else they wouldn't use it. In 1989, David Chaum introduced DigiCash, one of the earliest forms of digital money. It allowed people to withdraw digital tokens from their bank and use them online while staying anonymous. It used cryptography to secure transactions, but DigiCash was still controlled by Chaum's company. Instead of trusting a bank, users had to trust him, and that central control ultimately limited its success. Still, DigiCash introduced key ideas around privacy and security that shaped future cryptocurrencies. In 1998, Wei Dai proposed B-money, a revolutionary idea for a decentralized digital currency. It would let users verify and record transactions themselves, without any banks or middlemen. Though B-money was never built, its vision of a system free from central control paved the way for Bitcoin and the cryptocurrency revolution. That same year, Nick Szabo proposed BitGold, a digital currency with limited supply, like real gold. To create tokens, computers would solve complex puzzles, a process called mining. Each token was linked to the one before, forming a secure chain. Though never launched, BitGold directly influenced Bitcoin's design. Szabo also pioneered the idea of smart contracts, coded agreements that execute automatically, removing the need for third parties. Smart contracts would later become key to platforms like Ethereum. In 2004, Hal Finney developed reusable proof of work, a system to prevent double spending of digital money. With physical cash, once it's spent, it's gone, but digital tokens could be saved or copied after use. Reusable proof of work fixed this. When a token was spent, it was destroyed, and a new, verified one was issued, making digital money work like physical cash. In 2008, during a global financial crisis, an anonymous person or group, using the name Satoshi Nakamoto, published a paper, Bitcoin, a peer-to-peer electronic cash system. Bitcoin solved every past challenge. It prevented double spending. It had no central authority. It used a secure public system, the blockchain. Blockchain acted like a digital record book, not stored in one place, but copied across thousands of computers worldwide. To confirm transactions, Bitcoin used mining. Miners solved complex puzzles, earned new Bitcoin as rewards, and kept the network running, all without a bank in sight. In 2009, Satoshi Nakamoto mined the first Bitcoin block, known as the Genesis block. It included a hidden message. The Times, 3rd of January 2009, Chancellor on brink of second bailout for banks. It referenced a real newspaper headline, highlighting that Bitcoin was built as an alternative to government-controlled finance. On May 22, 2010, now known as Bitcoin Pizza Day, Laszlo Hanyecz paid 10,000 Bitcoins for 2 pizzas. At the time, they were worth $41. Today, those same coins would be worth millions. This was the first time Bitcoin was used to buy something in the real world. Later that year, Mt. Gox launched, one of the first Bitcoin exchanges. It made it easy for people to buy and sell Bitcoin, opening the door for wider adoption. Before exchanges, using Bitcoin was hard. Mt. Gox simplified things, helping Bitcoin grow from a niche tech idea to a global currency. In 2011, Bitcoin surged to $31 and grabbed worldwide attention. That same year, Litecoin was created by Charlie Lee. It processed transactions faster and used a different mining system. Litecoin proved that Bitcoin wasn't alone and started the trend of new cryptocurrencies being created, expanding the crypto world. Bitcoin crossed $1,000 for the first time in 2013. It was no longer a curiosity. Now it had real value. Investors, media, and financial experts started paying attention. In 2015, Ethereum launched, and it changed the game. Unlike Bitcoin, Ethereum wasn't just about sending money. It introduced smart contracts, coded agreements that execute automatically. Ethereum also made it possible to build dApps, decentralized apps for lending, trading, gaming, and more, all without central control. In 2017, Bitcoin reached nearly $20,000, its highest value yet. This sparked global interest in crypto as a serious asset. At the same time, ICOs, initial coin offerings, exploded. Startups raised money by selling their own tokens directly to the public. Some succeeded, but many failed or were scams, leading to calls for regulation. In 2020, big investors and companies started buying Bitcoin to store value, treating it like digital gold. Meanwhile, DeFi, decentralized finance, exploded. DeFi platforms let people lend, borrow, and trade crypto, all without banks. In 2021, NFTs, non-fungible tokens, went viral. They let people own digital art, music, and more, proving ownership using blockchain. Some NFTs sold for millions. At the same time, Bitcoin hit a new all-time high, over $60,000. Crypto was now firmly part of the mainstream. In 2022, the market crashed. Bitcoin dropped below $20,000, a steep fall from its peak. But this crash also sparked interest in stablecoins, cryptocurrencies tied to real-world currencies like the US dollar. Stablecoins offer the benefits of crypto without the wild price swings. In 2024, Bitcoin underwent another halving, reducing mining rewards, making Bitcoin more scarce and potentially more valuable long-term. That same year, Bitcoin was approved as a spot ETF, letting people invest in it easily through the stock market. This marked a major step toward crypto becoming fully accepted in traditional finance. As we look ahead, cryptocurrency continues to evolve faster than ever. New technologies are building on what Bitcoin and Ethereum started, aiming for faster transactions, lower energy use, and greater accessibility for people everywhere. Central banks are experimenting with digital currencies of their own, while governments debate how to regulate this growing industry. Artificial intelligence and blockchain are beginning to merge, creating smarter, automated systems that could reshape finance, identity, and data security. At the same time, questions remain. Will crypto finally replace traditional money, or will it exist alongside it? Can decentralized systems remain truly independent while governments and corporations step in? One thing is certain. The idea of digital money has grown into a movement, redefining how we think about finance, ownership, and trust. What would you like to learn about next? Let us know in the comments. Thank you for watching Timeline.